Something happened today that I heard, and I hadn't thought about this for a while, but there's mainstream media that they're supposed to walk the line and do what they're supposed to, whether it's CNN and whoever, Fox News. And if you don't, there's a good chance you might get out. Then there's the other level of news that you can get. That's what this show is today. So I want you to really stay tuned. Welcome to Mortgage Minute. My name is Jeff Harrison, and this is where we talk about everything that has to do with the housing market when it comes to getting loans, refinancing, home equity lines of credit, reverse mortgages, things like that. And the nice thing about it is I'm not the guy who has the answers. The answers are on the house, and the expert is Art Alvarez. Let's bring him in now.
Hey, Jeff.
Hi, Art.
How are you?
Good.
Hi,
Yourself?
Good. I guess we'll call ourselves the Mortgage News Network or the Mortgage Works News Network, huh?
Well, I heard that today. I'm like, oh yeah, there are people that are when they do. I have another trend watch that we watch and see what's going on online, on TV, and the numbers keep going down and down and down as far as people watching mainstream media because their trust is gone. So what's happening is they're turning to sources like you to say, let me find out what's really going on with somebody who will go deeper than just, okay, I can talk for 13 seconds on this and I go to the next one. And it's really surface level. So you take people a little deeper, and there's a lot of those going on out there. So kudos to you for doing this and committing to make this a part of that off mainstream media.
Sure. No, I think that's a good point. One of the things I notice when I'm looking at all the news feeds to try to get a grasp of what's going on, you can tell so much of it is sort of just headline based. And sometimes online you'll see a news article and it'll mention 1 minute read or 2 minute read, which in some respects I think is a signal that you're not really getting the full story. And I have a feeling a lot of folks end up looking at those articles and tend to pick the ones that are shorter reads. And then as a consequence, they're not getting complete information or really the implications of what that news is.
100%. Totally agree with that. Well, I know you have a lot of good information for us today. I'm going to turn it over to you. But before I do, I want to remind those people coming online and watching us live. This is a live show, so that means I'm going to be in the background. If you have questions, please put them in the comment section. Art is poised to take those because he has all the answers when it comes to anything about loans and home mortgages. So put those in there. If you're actually watching this taped, delayed, please put your comments in the section, whether it's YouTube or Facebook, and we'll take care of that as well. At that point, Art, I'm going to step out. I'm going to turn it over to you.
Okay. Thanks, Jeff. Good afternoon, everyone. Welcome to this week's Mortgage Minute. My name is Art Alvarez at Mortgage Works, where we have the answers and they're on the house. I want to jump right into giving you a rate update first. As you know, we tend to try to do that. There's our rate grid showing current terms available for various types of loans, conforming 30-year fixed, 15-year buy downs, FHA, VA, as well as jumbo and second mortgages, both HELOCs and HE loans. Hey, one thing I want to tell you or remind you, you hear on the news a lot the last couple of weeks that mortgages are now in the 8s. And during this week, I've had some conversations with some realtors who are saying, oh, I hear mortgages are in the 8s. Well, not true. For most, good qualified borrowers with a decent credit score and so forth, we're still in the 7s, mid to high 7s, depending on the product. Certainly, we're in the 7s, low 7s for FHA, VA. So if you keep hearing that rates are in the 8s, if you're talking to lenders who are telling you rates are in the 8s, or if you're an agent and your client is being told by a lender they're talking to that conforming loans are in the 8s, not quite true. We can offer you a better deal. Now, Jeff's going to also pull up the 5-day 10-year Treasury bond chart. And it's an interesting chart. And last couple of days have been really interesting because, as you can see there, we were at a pretty high level on the yield end of last week. And early this week, we were approaching, in fact, even exceeded a 5% yield around Monday, basically going into Monday. And then Tuesday, Wednesday, it dropped quite a bit. And then today, early today, we saw the 10-year yield going back up close to 5. And yet by mid-morning, a pretty significant drop back down to around the 485 level. So a very interesting change in the yield over this last 5 days. And so let me go over a little bit of what I think is going on there in terms of data points. This week, Most of the data points are related to new home sales, GDP or gross domestic product for the third quarter, and core PCE, personal consumption expenditures. The first big number that came out this week was new home sales, reported at a 19-month high, up 12.3%. That was quite a move upward. Now, that's not normally a data point that's going to move the market much, but it seemed to do that to some degree, given that shows a pretty strong number in terms of increased sales for new homes, not resale. And then today, the gross domestic product, the GDP for the third quarter, was forecast to be 4.7, but it came in higher than that, 4.9. And so initially, the markets, the 10-year bond yield early this morning was again approaching 5 on this very, very strong number. But yet here we are midday, and of course on Eastern time, we're essentially at the close of the day. It's dropped back down to 485. Not what you would expect given the very strong GDP number, but what it underscores is the financial markets, banks, economists are not fully convinced that this jump in the third quarter GDP, mind you, it was up quite a bit, 2.1 in the second quarter, more than double in the third quarter. The markets, economists, banks are not convinced that this is going to hold. They still see a lot of signs that the economy may start weakening soon. And one of those data points that I don't actually have on the chart here is initial claims for unemployment. This week's number actually was higher than expected, not a lot, about 210,000 versus 207,000 forecast. So that could have some effect on the bond yield dropping down from early this morning because of that strong GDP number. And then tomorrow we have core PCE, personal consumption expenditures. Again, that's one of the Fed's favorite inflation numbers to look at. It excludes food and energy. It is forecast to be up 0.3% in September. And that's up 0.1% from August. So we'll see how that plays out in terms of affecting the yield going into the end of the week. But, the little bit of good news is the 10-year yield didn't blow through 5% or didn't hold at that level. It's come back down nicely. So hopefully that bodes well for what we're going to see at the end of the week tomorrow. So that's your rate update. I wanted to go into something that I touched on last week in the program. I had mentioned the fact that, credit card rates are up 50% from their low point a couple of years ago. A big increase in rates for credit cards, not quite as big of an increase as mortgage rates, but still substantial. And yet, I pointed out that credit card debt is exploding. It's now over $1 trillion, which I thought, isn't that interesting that with credit card rates way up, credit card borrowing does not seem to be slowing down. In fact, it's been increasing, which is completely the opposite of what you're seeing in the mortgage market. Higher mortgage rates, now they've doubled, which is more than 50%, more like 100% increase. So that has definitely slowed down the mortgage borrowing. And yet people seem to be oblivious to the higher rates on credit cards and are using them freely, which is why we're now over $1 trillion in debt. And one of the things I pointed out in my comments last week, and I just touched on it briefly, and I want to go into it in a little more detail, is understanding the impact of credit card debt on your mortgage borrowing power. So what I did is I put together some numbers, and it's going to be on this next slide that Jeff's going to pull up. And when I put these together, I was frankly a little bit taken back. I really could not believe the impact of credit card debt on your ability to borrow, a mortgage or borrow a higher mortgage amount. And so what I did here is I made some assumptions. First of all, I'm using the average credit card interest rate currently is about 21%. So that's one of our assumptions. And then I'm comparing that to a 7.5% mortgage rate because yes, folks, good qualified borrower, decent credit score, we can still arrange conforming loans at 7.5, not 8. So I'll keep reminding you of that. But in this little grid here that I put together, look at these numbers. If you have a credit card debt balance total from all your credit cards, it's $25,000. And at a 21% average interest rate, the interest cost for that $25,000 of credit card balance is about $5,200 a year. Well, if you take that number of interest cost and calculate the equivalent mortgage amount that you could get for that interest cost at 7.5%, it's $70,000 in mortgage amount. In other words, what that is telling you is that if you're going to try to qualify for a mortgage at current mortgage rates and you're carrying $25,000 of credit card debt at a 21% average rate, you are going to have $70,000 less mortgage borrowing power than if that credit card debt was not there. And the numbers get even more astonishing the higher the credit card debt burden. Let's say you're a family with $50,000 of credit card debt. Again, using that same 21% interest rate, average interest rate cost for the credit card, that's over $10,000 a year. Well, if you're going to try to carry that debt and qualify for a mortgage, understand at the current 7.5% mortgage rate that I'm using in this example, you are going to diminish your mortgage borrowing power by $140,000. That's huge. And it gets even worse if your credit card debt burden is $75,000. And yes, I'm sorry to say, folks, I have seen that probably more often than I would like from prospective home buyers. That interest cost over a 12-month period, it's almost $16,000. And again, if you're going to try to qualify for a mortgage and you're carrying that much credit card debt, understand you're diminishing your mortgage borrowing power by over $210,000, as you see on this chart. That again is huge. So one of the things I would want to point out then, therefore, and you may already know this, having that much credit card debt is going to affect your ability to qualify. And to the extent you're frustrated because you feel like you cannot qualify for current mortgage rates, or even if you can, you don't want to pay current mortgage rates. Well, if you're carrying this kind of credit card debt, and to take a page out of Dave Ramsey's book, it would be very important to really attack that credit card debt, get it paid down, if not paid off, and understand that that freed up cash flow that you see on this chart on the interest cost column can then be reallocated toward a much higher mortgage amount. And so it'll help you qualify for a higher house price, home price, and a higher mortgage amount. So as I point out here in this slide, in many cases, if you're having trouble qualifying for mortgage, if you're carrying credit card debt, don't blame current mortgage rates because, again, historically, they're not that bad. Blame credit card rates. Those are the real culprit for those families who have a lot of credit card debt and at the same time are frustrated trying to qualify to get a mortgage. So I'm hoping that these kind of numbers will really spell it out for you, how important it is to really get that credit card debt under control, because particularly at the current rates for those types of loans, credit card borrowing, the rates are crazy high, and you're not going to build any wealth when you're borrowing a substantial amount of money at that interest rate level. So attack that debt, that kind of debt, so that you can reallocate your household budget more toward applying it to mortgage debt and get you in a better position to qualify for the mortgage. So I just wanted to cover that. Astonishing numbers. And I think with this information, it'll help you kind of redirect your household budget and get yourself positioned to get that mortgage to buy the home. So with that, I want to go ahead and go back to Jeff because we've got a couple of questions this week on our Q&A segment that we want to touch on. So Jeff, why don't you let me know what we got first to talk about?
Yeah, Art, let me just read this out because it was a great question submitted. It said at the outset, well, first of all, I have to say the example that you just showed in the chart, it's just amazing. I just kept thinking, wait a second, he's only showing the cost of the interest on that debt. That's if you're paying interest only, not including trying to reduce the mortgage, or reduce the amount of that debt. So that was crazy. So, yep. If you haven't reached out to Art yet to say, hey, how can I leverage the equity in my home and get those rates down much less than what I'm doing and my payments lower, you should do that now. So,
well, just to interject there, that's a good point because, of course, I was talking about on that slide, somebody who's carrying that kind of debt trying to qualify maybe to buy their first home. But for an existing homeowner who may have a lot of equity, believe it or not, some of those homeowners have credit card debt at that level too. And they may want to buy a bigger, nicer home, and they're wanting to avoid that because current mortgage rates are so high. But if they're carrying that much credit card debt, they may want to position themselves to attack that, through equity lending, get a HELOC, cut that interest rate in half. That'll help them accelerate paying that down and paying it off. Because you're right, you got to pay back the principal too, not just the interest cost. So that will better position the current existing homeowner to be in a better position to sell and buy something bigger and better later on.
Well, just very sobering news. Thank you so much.
Yep.
Okay, so the question, we have two questions actually. One, it says, at the outset of the show, you shared that new home sales are up strongly at 12.3% in September, which is a 19-month high. At the same time, resales dropped to a 13-year low in September. What does that tell us about the new home versus the resale market?
Well, it's a very good question. And when I saw this data point come out this week for new home sales, the increase of 12.3% in September, a 19-month high, it just screamed at the idea or the situation we have right now as it relates to the new home market versus the resale market. The resale market for September was actually, sales were down 15% year over year, and it's at a 13-year low. So how can you have this divergent differences in the sales rates for new homes versus resale? Well, I've talked about it a lot. I'm sorry if I'm sounding like I'm harping on it again, but a key difference is the new home market is much more focused on spurring sales by using financing as a tool to get more buyers into their sales offices, signing purchase contracts, and buying those new homes. And I read a couple of articles about this increase in new home sales, and there was reference to, a common theme that we've been talking about. Home builders are doing a lot of things strategically to offer financing incentives to get their homes sold. And the core strategy they're using is interest rate buy downs, either permanent interest rate buy downs. And what I mean by that is that's a case where a seller, in this case, the new home builder, in fact, in one article, they reference Pulte as a specific example, on some of their new home communities are offering a permanent buy down on a 30-year fixed mortgage at 5.75%. Now, a year ago, we would have thought that's not such a great rate. Well, right now, that's a great rate. And that is going to make a difference and has made a difference in attracting buyers who are, number one, frustrated that there's a lack of inventory in the resale markets. So they're going to new homes because there is a little bit more availability. And then on top of that, they're able to see that there's some very compelling financing incentives being offered. So that's a good example of a permanent rate buy down. Another option in terms of rate buy downs, I've talked about it a lot, and I'm going to bring it up again, is temporary buy downs. The most common ones are 2-1 or 3-2-1. Again, on a new home situation, those are oftentimes being offered to a prospective buyer, and they can make a huge difference in the monthly payments that buyer is going to incur in buying that new home. On the resale markets, on the other hand, while the rate buy downs are being used more than they used to, they're still not being used at anywhere near the level that the new home builders are using it for. And I think that is the key difference in these numbers. That's why the resale markets are struggling. There's a tight inventory. Prices are still elevated, although they've dropped a little bit in certain markets. But without the seller aggressively participating in offering incentives to that resale home buyer, a lot of those buyers are just sitting on the sideline because they're not able to really take advantage of any of these rate buy downs because they're simply not being offered. And in a situation where they are interested in a resale home, the more common strategy that's used is to try to offer a below list price to try to get an offer accepted. I just went through this with a real estate agent about a week ago, alerting me that they needed a pre-qual and wanted it done on a property listed for $675, but I was told that they were going to offer $625. Well, guess what? At current rates, each $1,000 less borrowed is about $7 a month in payment. So if you're going to offer $50,000 under list, you're going to save about $350 a month in your payment versus if you offered full price, at current interest rates. But if you instead maybe took that list price of $675 and offer $650, but then ask for a 3-2-1 buy down, which will cost you, if you have a $500,000 loan amount, it's going to cost somewhere around $21,000, $22,000, ask the seller to pay that. What that does is that first year payment is probably going to be about $1,000 a month less than what it would be at current rates. That's a lot better than $350 a month less if you just offer $50,000 below list. In this case, you're offering $25,000 below list, but then getting that other almost $25,000 concession in the 3-2-1 buy down. And then in that way, you're still getting that total concession that you're trying to get from the seller. And in some markets, that's possible. But you're getting a much better outcome for the borrower in terms of lower monthly payment, especially in the first year, but also in the second and third. And remember what I've said. Warren Buffett says, mortgages, unlike most other borrowing, he likes mortgages. Why? They're a one-sided bet. When you lock in a rate, in this case, if you're getting a 3-2-1 buy down, you're going to lock in the note rate, maybe at 7.5, 7 5/8. But you're going to get that subsidized rate and payment for the first 3 years. That gives you a 3-year window to refinance that note rate into something lower when rates do fall. So that's what he means by a one-sided bet. You can make an offer on a house, try to get a 3-2-1 buy down. Your note rate will be fixed at that 7.5, 7 5/8 range. So that's your worst case. That's your ceiling. For 30 years, your loan will never be higher than that. But if rates improve, you have that one-sided bet refinance option to refinance that note rate before you get to that 7.5 note rate in year 4 if you got that 3-2-1. So again, I can't stress this enough. If you're a seller or you're an agent with a seller and you're selling a property that's, say, under $500,000, in most markets, that's a first-time home buyer product. I would suggest you really should, once you've made a decision as to what your list price is going to be, you might actually consider adding another 5% to that. And then when you list, aggressively offer in your listing that you're going to offer some sort of financing incentive, such as a temporary buy down or a temporary buy down plus closing costs or a permanent rate buy down plus closing costs. And you might be surprised how much interest you might get, even though you're thinking you're listing a little bit high. Why? Because you're offering the financing incentive as an additional tool to greatly improve the monthly payment figures that buyer is going to be able to take into account when they're making that offer. So I really would urge you to rethink that. Try to use this kind of scheme as much as you can. New home builders do it very well. The resale markets, I think, are doing it a little bit, but I think they can do a lot more. And I think it would really make a difference in getting more resale homes, not just listed for sale, but sold and closed, so that we can see that number get a little bit better than it is.
Yeah, that seems like kind of a no-brainer because, as you said, this is something that I'm going to say new homes and builders and new car companies have used forever. They've always done that, and in both the resale side of homes and the resale side of cars, they haven't. And sometimes those used cars sit on the lot when they're real high interest rates to do exactly the same tactics. So it seems like. It's one of those things. It's like, how many times do we need to repeat this same story before they get it? Sometimes it needs to be 7 or 8 times that they need to hear that message before they say, oh, that's a great idea. Because even Art, I notice every morning I kind of look at the homes listed in my area, and all I see are new homes coming on and about 2 out of every 3, a price reduction notification. And I'm like, God, if they would check with Art and say, hey, is there a better way?
Well, that's true. And of course, one of the things I didn't touch on is with this big increase in new home sales, it's not like new home builders are not adjusting their prices too. They are. Now, probably not at the same level as the resale markets. I think the number was new home builders in September had price reductions in about 32% of the cases. But what they're doing is price reductions and the financing incentive combined to make it a really compelling package for that prospective buyer looking at that new home. And again, I just think the resale markets need to take that lesson to heart and really spend a little bit more time on the front end as they're deciding what price to list their home for, and incorporate financing into that number and be aggressive in marketing those benefits to that prospective buyer.
Brilliant, brilliant. Well, I hope this will reach the right people, and they'll see this, and maybe they'll have that discussion with their agent, or their agent will have that discussion with them and help them sell their home and take advantage of you, and reach out to Art Alvarez at 760-883-5700. We do have another question here, Art. I promised you two questions. And the other one is about impound accounts. And it's like, what is an impound account? And am I better off with or without one on my loan? And what are the pros and cons? I think this is a good one. People want to know this.
Yeah, it is a good question, and it's something that we encounter quite a bit, and there's a little bit of confusion about it, and there's some watch out fors about it as well. First of all, what is an impound account? Well, first of all, in terms of definition of terms, one of the things I would want to alert you to is an impound account can also be known as an escrow account. Now, that's not to be confused with the escrow company that might be handling your purchase of a home on the front end, but once the loan is closed and it's being serviced by a lender oftentimes will not call it an impound account. They'll call it an escrow account. So just understand that an escrow account or an impound account are essentially the same thing. Now, what an impound account is simply, in most cases, something that is voluntary. And what it does is it allows you to set up a situation where you're going to pay your taxes, your property taxes, and your homeowner's insurance through your monthly mortgage payment. Now, in some cases, you don't have a choice. For example, some loans, FHA, VA, where you're putting a minimum down payment, USDA, you have to have an impound account. In other words, your monthly mortgage payment is going to include 1/12 of your taxes, 1/12 of your insurance. Now, in California, once your loan to value hits 89.99 and you're getting a conventional loan, you are not forced to have an impound account for taxes and insurance. You can pay those expenses on your own. So let's say you're a buyer and you're getting a loan 20% down conventional. Should you get an impound account or not? Ultimately, it's simply personal preference. In some cases, I see this a lot. A home buyer will say, I don't really want to pay my taxes and insurance on my own when they come due. And typically, like in California, property taxes come due twice a year. The official due dates are November 1st and February 1st, but you get a grace period till December 10th for that first half taxes and April 10th for the second half taxes. And the issue there for property taxes, some homeowners, once they get their loan, they're a little afraid of having to come up with a 6-month installment of property taxes at those times of the year. Because if you think about it, most everybody takes advantage of the grace period. So for the first half taxes, 6 months worth of taxes, most folks are going to pay them right before the 12/10 deadline, December 10th deadline. Well, that's right at Christmas time when you're spending a bunch of money anyway. So that can be a little inconvenient. And then the second installment due February 1st, but grace period running generally till April 10th. Again, you're having to cough up with 6-month property taxes at a time that's a little inconvenient because it's right before income taxes are due and you may have to pay a liability there. And not so much with insurance, but kind of the same thing. Insurance typically paid once a year to renew your premium, although a lot of insurance providers will allow you, if you don't have an impound account, to pay your insurance premium on an installment basis. So really it comes down to, is it more convenient for you? Or in some cases, do you not trust yourself, particularly on the property tax side, to come up with those 6-month installments twice a year at those months where it's kind of inconvenient, December and April. In some other cases, if the homeowner has got lots of liquid assets, lots of money in the bank, and paying those 6-month installments or that once a year insurance premium in full is not financially a burden, and they're good at managing their financial budget, then in that case they'll often say, no, I don't need an impound account. And then one con, I would call it, of setting up an impound account is it does increase your amount of funds due at closing. And that's because depending on the timing of the year that you're closing your mortgage in, you may have to prepay several months' taxes in advance at close of escrow. And then that money gets forwarded to the lender to set up the impound account. Let me give you an example. Let's say you're closing in November. Well, by November, that first half taxes in California is already due, and that's going to be taken care of in your escrow for your purchase. and allocated between buyer and seller, so that first half taxes will be taken care of. But the second installment is, again, officially due February 1st. You have till April 10th. Well, if you close in November, your first mortgage payment isn't going to be until January. Well, if you think about it, if you only make a payment in January and February, let's say even March, that's 3 months. And yet by April 10th, the lender's got to have 6 months in that impound account to disperse that 6-month installment by April 10th. So how are they going to do that if you've only made 3 monthly payments where each payment has 1/12 of your annual property taxes? Well, they collect it in advance. And they're allowed a 2-month cushion. So even though you might think, oh, they only need to collect 3 months taxes, no, they're probably going to collect 5 or 6, so they can have that 2-month cushion. So that can be a little bit of a burden for somebody who's tight on cash to close, that you have to come up with this money in advance to set up the account. And with homeowners insurance, when you're doing an impound account, you're going to pay your first year premium at closing, and then an additional 3 months will be collected to set up the impound account for insurance. So that's sometimes a burden. And again, if you've got plenty of money in the bank, you manage your family budget well, you may not be interested in doing that. You'd rather pay less at closing, and then you'll just pay those taxes and insurance on your own. So again, it's personal preference. It's a style thing. However, I want to bring up one other point about impounds that can be a little bit of a watch out for, and that's the supplemental property tax bill. When you close escrow, if you're getting an impound account, your impound account is going to be based on a property tax formula calculated off of your purchase price. And so that's how that impound account will be set up, with those numbers, with that new estimated property tax amount based on your purchase price. Because eventually, when the county assessor becomes aware of your purchase, they're going to reassess the value of your property based on the price you paid for it. But in most cases, the assessed value when you first buy the home is going to be a much lower number, or certainly somewhat lower, maybe much lower, particularly if it's a new home, where initially the property taxes were based on when it was a piece of dirt. That can be really tricky, because the challenge there is, again, let's say you're buying a brand new home. When your loan closes, your impound account is going to be based on the estimated tax amount based on your purchase price. And then what's going to happen is each month you're going to start making payments toward the loan, where 1/12 of that new property tax amount based on your purchase price is going to be pulled out of your payment and put in the impound account. The problem with that potentially is the previous assessed value when the builder bought the land is much, much, much less. And so what can happen is eventually you're going to get a supplemental tax bill. And in the case of a new home, that supplemental bill could be very high in terms of the amount. And remember, a supplemental tax bill is a one-time bill. It's not ongoing. It's intended to catch up on the value calculation from when you bought it versus what the property is worth when you bought it from the seller. And so as a consequence, two things to understand. One is, when you get that supplemental tax bill and you have an impound account set up, it will not be paid by the lender. You have to pay that as the borrower, as the homeowner. So that's the number one thing to understand. When you get that supplemental tax bill, don't think that, oh, I have an impound account, the lender will take care of it. Don't think that. They will not. You have to pay it yourself. The other thing to watch out for in that same scenario, understand that the period of time for the county assessor's office to become aware of your transaction and recalculate the tax basis based on your purchase price can take a really long time. It can take up to a year or more. I had one client, it took almost 2 years before they got their supplemental tax bill. The problem with that, particularly if you're buying a new home where the assessed value of the property was very low because it was a piece of dirt before you bought it, you could run into a problem where you're paying your taxes, your monthly payment every month. The taxes being pulled out is based on your purchase price, which is much higher. And after a period of time, if that supplemental bill hasn't come out, and more importantly, the next annual bill hasn't come out, the lender is going to run into a problem where the amount of the impound account for taxes will start to accumulate and be too high. It will exceed the cushion amount that they're allowed. What could happen in that situation? They may end up sending you a large refund check out of your impound account. When you get it, you think, oh, great, found money, and you don't think about it beyond that. You spend it. And then few months later, you get that supplemental tax bill. That's this huge number that at that point becomes inconvenient, in part because when you got that impound account refund, because the supplemental bill didn't come out quick enough and the annual tax bill after that didn't come out quick enough, you should have kept that money, because that's going to have to be used to cover that supplemental tax bill. So we see this all the time. I get calls on it all the time. Very important to keep that in mind. That's probably the biggest con of getting an impound account, is just understanding that process and the watch out for as it relates to supplemental taxes. Jeff, back to you.
Boy, those are 2 points on the con side that got the hair on the back of my neck standing up. Like, oh, geez, that could be, especially like you said, there's that lag time. We have lives, we get going, and we forget about that, and all of a sudden we're like, hey, we got all this extra money, and then we got this big bill. So, great points.
Yep. Yeah, I always try to make it very well known by my customers that if you're getting an impound account, first of all, understand that part of your closing costs is just that advance money to set up the account. So you shouldn't think like you're being charged by somebody, some third party, for some fee. It's basically just advance funds for your future tax and insurance obligations. So in that regard, I don't think it should be considered the same as third party fee-based closing costs. So that's one thing I always try to stress. And then again, understanding you're going to get a supplemental bill. Don't just be casual and think the lender's going to take care of it because you set up that account. You got to pay that yourself. You have to be prepared to pay that yourself so it doesn't become delinquent and you're paying late charges and all that.
Just a real quick follow-up question, because I've got you way over schedule. I apologize, but I'm just curious. Is there a level of responsibility? Like, is that something that your lender tells you should be your closing agent? Who's supposed to tell you that? Is that an escrow? Who's supposed to remind you of that?
Oh, the supplemental bill?
Yeah.
Yeah. Closing agent may alert the borrower. I would say that's probably not done very often. I think when the lender first boards the loan on their servicing system and they send their initial documents like monthly payment statements, welcome letters, and so forth, some of that may have some information to alert the borrower. But let's face it, most folks don't really read that stuff very well. So that's why we make a point of just warning our customers to be prepared for that supplemental bill, because it can be a real hit to your financial budget that month if you're not expecting it and planning for it.
That's great. Well, I'm going to turn this back over to you. I think we have closing questions, and I'll turn it back.
Okay. Thanks, Jeff. Last week's closing question, I have it up here. After executing a rate lock agreement, if the market improves, can the borrower get a lower rate? The answer is yes in most cases, and it's subject to conditions. Let me go over them because it's pretty much the same with all the lenders we do business with. In this kind of scenario, it's known as a rate renegotiation or a float down, number one. Understand that some of the conditions include broker compensation cannot increase from the original lock term. So we, as the broker who are originating a loan and delivering to the lender, if we have an opportunity to renegotiate the rate lock, we cannot do that where the outcome is going to increase the compensation to us. That's not allowed. Also, rate renegotiations are usually limited to certain loan programs, mostly conforming loans, Fannie Mae, Freddie Mac, FHA, VA, some jumbo loans, non-QM loans. Typically, a rate renegotiation is not generally available. And when you're requesting a rate renegotiation because the market has improved after your initial rate lock, you usually have to have the loan at least to an approved status or cleared to close where it's ready for docs. You can't get a rate renegotiation early in the process if the loan's not even underwritten and approved yet. Also, you cannot renegotiate your rate if the market's improved if you've already signed your closing docs, but the loan hasn't funded. You're too late. You can't go back and renegotiate that. Now, when you renegotiate a rate lock, because I understand what you're doing here, you're basically saying, okay, I initially applied, I requested a rate lock, but then a couple of weeks later, 3 weeks later, the market improves. Now I'm going back to the lender and saying, hey, I didn't mean it. I was kidding. I want a better rate because I hear the market's improved. In the old days, we had to just deal with that. There wasn't any scheme or process to address that. We had to essentially convince the borrower, hey, look, this was a, in good faith, negotiation and agreement. You requested the rate lock and you're basically trying to back out of the agreement. We had to just deal with that in the old days. Now what you can do is you can renegotiate the rate, but it's not free. there's typically going to be a relock fee. In this case, in most cases, a half to 5/8% of your loan amount. So think of it like a half a point or 5/8 of a point of your loan amount. That's going to be your fee to renegotiate the rate. Usually the new rate you're asking for has to be at least an eighth better than your current locked rate. And the existing rate lock expiration remains unchanged. And then if you have to have extensions after that, then you're going to have. A practical reality is, and generally speaking, if let's say you're locked at 7.5, you're probably going to have to see the market improve to say 7.25. And again, we're assuming a 0-point rate in both cases. Now, one option is if you locked at 7.5 at 0 points, the market's improved to 7.25 at 0 points, and you're approved but not closed yet, you can request a rate renegotiation. Let's say it's going to cost you half a point. Well, one thing you can do is take that 7.25 rate, but it won't be at 0 points. It'll be at a half a point. Why? Because of the relock fee. Now, a lot of cases, the borrower doesn't want to pay the fee, but they want a better rate. So the way to do that is absorb the fee into the new rate you're asking for, kind of like splitting the difference. So in my example, if you're locked at 7.5, 0 points, current market 7.25 at 0 points, you may want to take 7 3/8 as your new rate, an eighth lower, and that new rate slightly above current market is enough to absorb that half a point relock fee, so it's paid out of the rate, not out of pocket. So that's the way it's done in most cases. Now, some lenders will say, we can float down your rate. There's no additional cost to you. That's getting to be pretty rare. Some banks will do that, maybe credit unions, but in most cases, your renegotiation of the rate lock is going to follow these parameters more or less in almost every situation. So with that, let me go ahead and go into next week's closing question. And this is something I actually touched on last week in our program. As I mentioned here, last week, you mentioned a mortgage price. Isn't getting a mortgage all about rate? What does the term mortgage price mean? Well, think about that. Next week, I'll provide you some answers. They'll be on the house. Jeff, back to you.
Art, another great show, informative. This whole thing about the 3-2-1 buy down. I'd love to, if before I let you go, let me just click back to your rates, and I just want to bring that up. And I just want to, because I read the article that you were referring to and what the rates were. Like the 30-year 3-2-1 buy down is 4.625. I think they were talking about in the new homes. They were pretty excited about a 5 point. I think it was over 5.5, if I'm not mistaken.
Well, that's true, but that's where you have to distinguish the kind of buy down we're talking about. In the article referencing Pulte Homes, they were offering in certain communities a permanent rate buy down, 5.75 for a 30-year loan. So it's 5.75 throughout the 30 years. So that is another option. And by the way, a slight benefit of that is if you're looking at an opportunity to get a permanent rate buy down, either from a new home builder or maybe a resale home where the seller's willing to pay for a permanent rate buy down, the benefit to you as the borrower is you do get to qualify at that lower permanent bought down rate, which can help with your debt ratio if you're tight on debt ratio. With a 3-2-1, we call it temporary because we're not buying down the note rate for the whole 30 years. The note rate in this example on our rate grid is 7 5/8. So what's happening is we're subsidizing the rate 3% the first year. That's how you get to the 4 5/8. Then 5 5/8 the second year, 6 5/8 the third year. So that gives you a 3-year window of lower monthly payments over what they're going to be in year 4 when the 7 5/8 note rate hits. So that gives you that 3-year window to hopefully see rates come down, refinance out of that loan, and get your note rate below the 7 5/8. So that's the difference between that 5 3/4 offer that Pulte was offering. And keep in mind, with the 3-2-1 option, you are not qualified. Your debt ratio is not calculated on that bought down rate of 4 5/8. You are going to be qualified. Your debt ratio will be calculated on the note rate of 7.625. That's important to know because that takes away or should take away your concern that when you get to that 4th year, you're not going to be able to afford the payment because the lender is going to establish when you get this kind of loan with this kind of structure that even right now today, when you get the loan, your income is sufficiently high, your debts are sufficiently low that you're going to meet the debt ratio requirement at that note rate of 7 5/8 in year 4. So you're protected from being put in a situation where you're not going to be able to qualify in a few years down the road. Something that's different than what we saw before the crash of '08, where people were qualified at below market rates and not prepared for that end rate once the buy down period was over.
Well, that was the one question I was going to ask. Is that comparable back to, the '08 where it was adjust rate mortgages and all of a sudden it's like, I can't even afford to live in this home anymore. So they're already making sure you can qualify for the rate once it's done with the temporary buy down, right?
That's correct. So it's all a cash flow play.
Great.
It's perfect for the homeowner, the home buyer, I should say, who can qualify for today's current rates, but they don't want to because they don't like the payment. Because I run into that. I run into people who are qualified at today's rates. They just don't want to pay that rate. This gives them relief for 3 years, again, with that opportunity for that one-sided bet of refinancing into a lower note rate.
Just seems like a great option. Make sure you reach out to Art at 760-883-5700. Of course, you can always get him on his email at art@mwloan.com. And please go to their website and you can check out things like the rate grid. And there's all kinds of calculators you see along the bottom here that can help you out. Art, before I let you go, any last closing thoughts? Because today was packed with a lot of good information. Just a note to people that are out there listening.
Well, one other thing I want to mention, and I've been meaning to mention this for the last couple of weeks, little news item, the maximum conforming loan limit in the U.S. is increasing. It's 726,200 for 2023. It's going to go up to 750 for 2024. And we have lenders now who are already accepting applications at the new conforming limit that is projected to be at 750. It's about a 3% increase. So in part, that reflects the fact that that home prices have remained firm, elevated, because that increase or that change in the conforming limit is always based on median home values for the previous year. So 750 is going to be the new conforming limit going into 2024. What's important about that, for those of you who are down payment challenged, that means you can buy a home and get a $750,000 mortgage amount with a 3% down payment if you're a first-time home buyer. So you can buy a home for nearly $800,000 with 3% down and get that conforming loan amount, which is where you're going to get the best rate possible. Of course, you have to have a lot of income to qualify for that kind of loan amount level with that 3% down payment, but there are people out there, and they should be aware that that's going to be available. It is available now.
Well, that's great news. Hey, speaking of news, I want to bring up your contact information again. We mentioned Art Alvarez at 760-883-5700. Of course, he always has his cell phone on and charged at 714-612-9035 to take any of your questions about getting loans, whether it's a new loan. And here's the thing, folks, don't be afraid of that new loan, especially when you can talk to Art and get an idea of using something like the temporary buy down 321. And also, of course, the website is mwloan.com. And as I mentioned before, Art at mwloan.com. Art, thank you so much for taking the time. And again, you are cutting edge because you are an independent news source, not the mainstream media giving us the facts. Thank you.
You're welcome, Jeff. Thank you. Thank you, everyone, for watching and listening. Thanks for this, viewing our Mortgage Minute this week. Stay tuned for next week. My name is Art Alvarez. I'm at MortgageWorks, where we do have the answers, and they're on the house. So long. Take care.